What will the new dividend tax calculations look like? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. The tax on dividends and investment income has changed in the recent budget. So how does that change look and what are the numbers going to look like? Let's dive into some calculations straight away and see how that's going to impact those on a variety of income levels so that we can just see what is going to be the actual change and how much extra tax are we going to have to be paying. Our example today is going to focus on two specific areas. First, we're going to have a look at a basic rate tax calculation and then we're going to look at a higher rate tax calculation. So our example in both cases is going to stick with a salary of $12,500. We've got rental property for both individuals, but we're going to be looking at different levels of dividend, with our first one keeping their dividends under the basic rate threshold of $50,000 and the other one going over it. So let's have a look at how much tax we are unfortunately going to be paying. So as you'll see on screen, which hopefully isn't too little for you, but let's talk through the numbers anyway. We've got our salary of $12,480. In our example for our basic rate taxpayer, because we have rental income of $15,000 and expenses of $2,000, we've got dividend income of $22,000, which is going to keep us nicely under our $50,000 limit. We've also got some mortgage interest at $2,500, which will come into play later in the calculation. So the first thing we're going to look at is what is our total income. So we've got our $12,500 gross salary, we've got our dividend income of $22,000, and we've got our rent, which is $15,000. Take away our direct expenses of $2,000, which is giving us $13,000 of rental income, or rental profits, should we say. So our total income in this case is going to be $47,500. Now, working through our tax calculation for the current year, 24-25, and going into 25-26, now that's the tax year that we're releasing the video, and we will have our personal allowance of $12,570, which is not changing. We've got now our basic rate tax at 20%. Now, our salary and our rents are taxed at the 20% tax rate at this point in time. So on that basis, we've got $12,910 that is going to be taxed at this rate, giving us 20% on tax of $2,582. Now, our dividends, we will always at this point still have our $500 at 0%. So we've got $500 tax-free at this point in time, which leaves the remaining $21,500 being taxed at our tax rate of 8.75%, which is the one we are working with at present in the 24-25 tax calculations that you may be doing for your tax returns, and the 25-26 tax year, which is the one we're actually in and approaching the end of in the next few months. This means that for 8.75% tax rate, we are at £1,881.25 tax. So our total tax at this point is $4,463.25. However, as we've always said, before you finalise the figure, we need to look at those finance costs. And this is going to be the lower of the finance costs, the property profits, or the adjusted total profits. So as you will see at the bottom there, we have finance costs of $2,500, we have property profits of $13,000, and we have the adjusted total profits of $47,480. Hopefully, deductive reasoning will agree with me and say that the finance cost of $2,500 is the lowest amount, which therefore means the $2,500 at 20% means that we will reduce our tax liability by £500, which gives us tax to pay of $3,963 as it sits at the moment. We're now going to jump into the next tax year and into the future and how it will be going forward based on our new tax rates for our dividend tax, and we're going to keep all the rest of the numbers the same. So our salary is the same, dividends, rents, mortgage interest, repairs, all of those we're not going to change. So we can see a direct comparison. Now, the tax calculation works in the same way because we have our personal allowance on our salary first and a little bit on our rents, which then means the rest of our rents are going to be taxed at the 20%, which gives us tax of $2,582, which is exactly as it was before. Now, our dividends, we still get our $500 at 0%, which means there's still that tax-free amount. However, our $21,500 is now going to be taxed at 10.75%, which is 2% more. So our tax on this is now going to be £2,311.25, giving our total tax bill of $4,893.25. However, as we said before, we have got our finance costs, and as we mentioned before, they have not changed. The numbers are all the same, so we're still going to have that £500 reduction in our tax for the finance costs reducer. But this time our tax is slightly higher, so our tax liability after all those adjustments is going to be $4,393. This is going to be with no change in any of the numbers apart from the tax rate, as you'll hopefully see if you make the screen a little bigger, that there is an increase in tax with no changes in your income or your expenses of £430 with this example. So we are just looking at a direct shift, there's just a direct change, and there is an increase in tax. Unfortunately, there's not too much that we can do about that at this point in time. However, hopefully, because it is only 2%, it is not going to be big numbers for you at this point in time. Let us move over to our higher rate tax calculation then and see what the impact is when we move into the higher rates of tax. So on this basis, we are now going to look at example number 2, where we're again going to have a $12,500 salary. But our dividends are going to be slightly higher at $35,000. Our rents have shifted slightly, so we've got rents of $18,000, less our mortgage interest of $12,000, and we've got repairs and expenses of $8,000. So our gross salary of $12,500, dividends of $35,000, our rents less our rental expenses of 18 take away 8 gives us 10. So our total income from our sources of income now are up at $57,500, which means we are squarely at the bottom end of the higher rates of tax. Now, tax calculation we therefore need to look at is our $12,570 personal allowance we are still getting. The basic rate band we are going to be taxed at is £9,910 at 20%. So this is giving us tax on our rental income in essence of £1,982. Because we are still getting the $500 tax free or the 0% dividend, we're still getting that $500 dividends at no tax rate. But now we're at the $27,290, which we can now use towards our basic rate at the 8.75% tax rate currently. So this gives us $2,387.88 as our basic rate tax liability before we jump into our higher rate of tax, which is at currently 33.75%. So we've got 33.75% on the element of our dividends that takes us over the $50,270 of $7,210 to give us tax of $2,433.38. So our total tax charge at this point with our higher rates of income is £6,803.25. But we don't want to forget that we've got our finance costs, and in this one they are slightly higher. So let's look at how we calculate the reduction. So we look at the finance cost, the property profits, or the adjusted total profits, and it's the lowest figure of these. So our finance costs here are $12,000. Our property profits are the 18 take away 8, which gives us $10,000, and our adjusted total profits are $57,480. So hopefully you can see on this example that our property profits are actually our lowest figure of $10,000. So this means our reducer is going to be the 10,000 at 20%, which is 2,000. So our total final tax liability is £4,803. So let's move forward in time and go into the future and look at next tax year, assuming everything stays exactly the same, which is highly unlikely, to be fair, but things may stay relatively similar if you have minimal expenses on your properties or the same expenses and you stick with your dividends being the same. So our total income again is our 57,500 that we are starting with. So our personal allowance, as you will see in the budget updates, has not changed going forward. So we're still sticking with our 12,570, which, as you'll see, I've split that down a little further now. So we have 12,480, which is used against our salary, and £90, which is used towards our rents, leaving us 9,910 at 20% for our 1,982 tax on our rental income. Now, we're now onto our dividend taxes, and our dividend rate of 0% is appropriate for our first £500. So again, we get that tax-free element. Then we are moving on to our basic rate band, and we have 27,290 left of that 37,700 that is part of our basic rate band, but now we're being taxed at 10.75%. So this means rather than paying 2,387.88, we will now be paying 2,933.68, which is basically that 2% increase in tax on that amount of money. We're then in the high rates of tax, so anything over the 50,270 will be taxed at the new tax rate of 35.75% rate. So on that basis, we are paying tax at 2,577.58 compared to 2,433.38. So overall, we'll be paying £7,493.25 of tax. However, we still can get our finance costs reducer. So it's exactly the same as before with our finance cost of 12,000, property profits of 18 less the 8 to give us our 10,000, and our adjusted total profits are our 57.5. So we take the lowest of those numbers, which is our 10,000, and we calculate our reducer at 20% to give us 2,000. So our final tax liability after this is going to be 5,493. So we've now got an increase in tax on this calculation, with the numbers staying exactly the same, being £690. So as you can see, it's not big numbers, but it is a little extra that you're going to have to be paying in tax, potentially paying on payments on account going forward because the tax bill is slightly higher, which ultimately means that we are going to be seeing less disposable income unless you are giving yourself additional dividends, managing to push your rents up a little, where you'll pay a little more tax, but hopefully end up with the same net figure. So it is just something to be aware of as we're going forward into this slightly increased dividend tax regime, because if you're sticking with the same dividends, if you're sticking with the same amount of tax that you pay, then you will either be receiving less money if you're trying to stick with the same tax, because you'll be receiving less money. If you're receiving the same income, then you'll be paying a little extra tax. So you just need to have a think through as you plan your dividends from your business, from your property company, to decide how much income you need, how much tax that is going to mean, so that you can just make sure that it is going to be working for you, for your business, for your family moving forward. One thing to just mention now is we have discussed everything to do with changes in dividend tax, but do check out the videos that are coming on the changes of rental income as well, because that tax rate is also changing from 2027-28, which means we've not covered it yet in these examples, and there will be some more examples coming in this area to help you with your planning. But do keep an eye out for the rental income changes as well if you have any rental income, so you can see how that will fit together as well in the future. If there are any questions, then please do leave some comments and we can add any further examples or answer any questions to help you understand what is going to be happening from April 2026 with the changes regarding dividend tax. As you can see, there is going to be a bit of a change. Hopefully it's not too big, but let's see how it goes and check out more videos as we approach the time where it's actually going to be implemented into our tax system. Hopefully today you've got an idea of how the new dividend tax calculations will look as the changes come into play. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing. Let's make tax less taxing.